Hello, everyone. My name is Charles Warburton, Senior Director of Channel Partners with CFRA. I would like to welcome you to today's webinar by Investors Observer and CFRA titled Find Profitable Options Trades Based on Your Strategy. During today's session, we will hear from Bobby Rains, Editorial Director, Freshbeard Media, as he walks us through how to use our powerful research and screening tools on MarketScope Advisor to find options trades based on your strategy and the criteria that is important to you and your clients. Bobby Rains is the editorial director at Investors Observer and oversees a team of analysts that manage model stock and options portfolios. He is the chief architect behind the algorithms that are the backbone of Investors Observer's state-of-the-art options technology. Over the past 8 years, he has successfully managed thousands of options trades in a number of options services for Investors Observer's direct-to-consumer products. Before we get started, I wanted to remind you that today's session is being recorded and a link to the recording will be made available within the next few business days. During today's session, you may submit questions using the GoToWebinar Questions panel, and we will do our very best to answer as many as we can. Before we dive in, I'd like to provide some context on CFRA. I'll also give you some context on CFRA's relationship with Investors Observer. CFRA history. Our clients and end users know CFRA, and increasingly, so do many more. We have a history that dates back to 1927, and notably, the firm bought S&P Global's equity and fund research business 2 years ago. We are now one of the world's largest independent research firms. In terms of our collective history with Investors Observer, the relationship stretches back to 2005 with S&P, through MarketScope Advisor then, and continues under the CFRA banner, also on MarketScope Advisor now. CFRA clients. Many kinds of clients and end users, leaders in their industries in fact, use our research to make more successful investment-related decisions. Independence. If you want to work with a research firm, you've come to the right place. Our focus is research, and we don't compete with our clients. We don't raise capital or gather assets or provide corporate access or have a bunch of other businesses and offerings. We're focused on research. So by the numbers. Importantly, CFRA offers substantial scale in our multi-asset coverage. Our large and global team covers 1,500 stocks of companies from around the world on a qualitative basis. We also cover more than 1,800 ETFs. We also cover more than 11,500 companies on a quantitative basis, and we cover all economic sectors and industries. So with that in mind, I'd like to switch over to Bobby Rains of Investors Observer.
All right, thanks, Charles. So let's get started here. If we can go to the next slide, I have a little agenda to go over what I'm going to be talking about today. We're talking about why options can be an important part of any sort of practice that you're doing in the market. Specifically, what most of the CFRA options product focuses on is covered calls, so we'll talk about that. We also have some diagonal spreads, so we'll look at those two strategies there and how they relate to each other, and then talk about the actual option strategies product, look at how to navigate the options tab on the MarketScope Advisor platform, and then go into the option report. All right, so let's get started. Okay, so this chart is exactly what it says, daily average option volume. It's pretty steady up and to the right. You can see it sort of plateaued there a little bit in the post-financial crisis era, but it's back on the rise again as more and more people find things to do with options in their portfolio, ranging from hedging to speculation and all sorts of things in between. And on the next slide, we will see the number of equity issues. So essentially, tradable equities peaked in 2014, 2015, somewhere in that range, and it's actually down since then. And there's a number of reasons for that, but like even as there are fewer and fewer stocks to trade, people are trading options more and more. All right, let's go to the next slide. All right, so why covered calls? This line here is what statisticians would call the standard normal distribution, and that's essentially how the option pricing model works. And if we can get advance one click there. Yeah, so if we buy a stock for $59.19, we can see the profitable outcomes on the curve in the next slide. Okay, right? You buy a stock, half of the things that could happen to it are it goes up, the other half are it could go down. So the shaded area here is essentially where you're making money. Certainly the equity research from CFRA can tilt those odds in your favor a little bit, right? Like you probably, if you buy a stock that has a high rating from CFRA, it has a much better than 50-50 chance of going up. That's the whole point. But we can tilt those odds even further in our favor by using options. So let's go ahead one more. Okay, so we're going to sell a call that goes out about 2 months with a strike price of 55, which is less than the stock price, but it knocks our total debit, so price for buying the stock, less what we bring in for selling the call, down to 53.09, which, let's see what that looks like on the chart. One more. All right, so we just put a lot more of the high part of that curve, which is essentially the likely outcomes, into our shaded area, and essentially took some risk off the table. So let's go ahead one more here. So we got more than 10% downside protection. We took our break-even price from 59 down to 53.09. And we also have a target return here of 6.3, which is the difference, or sorry, 3.6. The difference here is the difference between the $55 strike price and our debit of 53.09. So essentially we're into a position for 53.09 cost basis. And if everything goes according to plan, we can get out at 55 and we pocket the difference. All right, so give me one more click here. Okay, so 6.3% is, or sorry, 3.6% from our initial price of 59.19 is 61.32. So the stock above 61.32, we're not as profitable as we could be otherwise, but below 59, all the way down to 53.09, we're doing better than we would have. So what we've done is we've traded away some of the essentially things on the downsloping right tail in exchange to capture some of the the high part of the left tail there. That's all we're really doing here, is just trying to be profitable under a wider range of outcomes. So go ahead one more. Yes, all right, so diagonal spreads. Diagonal spreads are often called synthetic covered calls. I've heard it called poor man's covered call also. But essentially, instead of buying that stock for, in this example, it was 58.73, which is almost $6,000 if you're doing 100 share lots. You can buy another call that's long dated, so it's not going to expire at the same time as the shorter one. And we can get into a similar position here as we would with a covered call for $9.50 a share instead of almost $60 a share. So it's levered up a little bit. It has a lot higher potential return because there's a lot less capital at risk. And this is called a diagonal because in option trading, if you have a trade where the strike prices are different and the expiration dates are the same, that typically will be displayed vertically on any sort of option chain. Whereas things where the strike prices might be the same and the expiration dates are different, those tend to be horizontal. So it follows naturally, if you change both strike price and expiration date to be different, you end up with a diagonal line. And so, yeah, a diagonal spread is a way to put a little bit less capital at risk without being as risky as some other strategies. And essentially what happens is that long dated call you buy gives you the right to buy the stock at the strike price of that call. And so your the obligation created when you sell the call is covered there. So you're still at a sort of fixed loss, fixed gain sort of position. All right, let's look at the option strategy product. We cover every stock that CFRA rates at 3, 4, or 5 stars. We produce covered calls every single day for as many names as possible. Some things the math just doesn't work out, and so there's no trade for those. But if we can make the math work and make it look good, we'll put that trade out there into the product. We also do a diagonal spread for all of those where the math works. There's diagonal spreads are a little trickier, so it's a little bit fewer than the covered calls, but many of the names that have a covered call will also have a diagonal spread. We also have an out of the money covered call for the 4 and 5 stars. Oh, wait, I skipped a bullet here. We also cover all the ETFs ranked by CFA. Again, a lot of the bond ETFs and some things like that, there's just not any option premium, so these strategies don't work, but everywhere where the math works, ETFs are also included. And yes, for the 5 stars and all of the ETFs, we also have an out of the money strategy that offers a little bit less downside protection than, say, the example we looked at earlier, but has a higher potential profit. And so certainly for the 5 stars and things like that, that can be a way to sort of goose your returns a little bit. All right, and yes, you can search through hundreds of trades available, again, updated every morning. Obviously by ticker, you can look at just the 5 stars. You can say I want trades that cost between $30 and $60 a share. And then of course, return rate, downside protection, and a few other metrics like that. We also have some lists available. The CFRA Power Picks is one of them. We also have what we call our best 10 list for a couple of different sort of groups here. We have I think it's a 4 and 5 star best 10 list. We also have an ETF best 10 list. So if you just don't want to spend a lot of time looking, you just need some quick ideas, we've got you covered there. All right, let's go to the next slide. So the product also includes, in addition to all those option trades, our morning update, which includes 10 trade ideas every morning, plus a quick look at the overnight markets. And then we have 2 market briefs that are published to the options tab on the MarketScope Advisor every day. One comes out pre-market. It looks at international and commodity markets, as well as sort of the overnight action. And then there's one mid-morning, which talks about basically what's moving today and has a few option market statistics. And then we also publish 3 intraday trades based on analyst actions at CFRA. So all the option reports and trades and things like that are published overnight. Right now especially, there's earnings coming out, all kinds of things are going on. And so, say a company reports earnings this morning, the analysts at CFRA say, oh, we're gonna upgrade, downgrade, whatever the analyst action is based on that news, we'll put out a trade after that. So that's even fresher than the other stuff that we're refreshing overnight. And those come out, mid-morning kind of time. All right, so how to find them. So this picture on the left here is the options tab. Obviously that doesn't fit on one screen. There's a lot of scrolling involved. But I have captured the top piece here. So you can see the first 2 links there are investors keyhole market information. That's where you can go to find those 3 intraday trades as well as the market briefs. And then the daily morning update is the next one, and that's right there. It usually comes out, it's usually a few minutes before 9 a.m. Eastern time every morning. And so those are good places to go and find those. All right, next. Okay, so this is what one of the intraday trade alerts looks like. The bottom piece here is the CFA research note. You can see maintain buy rating on a certain company. And so we put that in there so you can see what's going on. That equates to 4 stars. And then we have the strategy all laid out here. Essentially, it tells you exactly what you need to do, gives you the price for the stock and the option, and what we call the net debit, which is the price for buying the stock less what you bring in from selling the option. Assigned return, whether or not you can expect the dividend. Sometimes we'll throw in when the next earnings date is, if that's available. And then there's a little bit of sort of technical analysis there. And then an evaluation of the risk, essentially how far the stock has to go down to hit our break-even point. And KEYS is a proprietary risk metric that Investors Observer developed, which you can read more about on the option report. All right, next. All right, so the next piece we're going to look at is down here. You have to scroll a little bit to get to it, but this is where you can get into all of those option reports. So you can see, you can click to see just the 5 stars, the 5-star out of the monies. You can look at just the 4s, the 3s, best 10 lists, best 10 out of the money, that Power Picks portfolio, and then this box over here on the right side is how to search. So you don't want to look at our list, you want to make your own list, go here, hedge strategies, sort search, and then we can see what that looks like on the next slide here. All right, so it's a pretty simple search box. You can put a ticker symbol up there at the top, and then there's check boxes for what you want included. If you want just the Power Picks, just the best 10, just the 4 stars, just the 5 stars, 4, 5, and 3, whatever you want to do there. You can click one of those boxes, and then you can see you can enter in as much information as you want here or as little. I just searched for covered calls that cost less than $100 a share, have at least 5% downside protection, and an annualized return rate of greater than 10. And then on the next screen here, you can see I just captured I guess it goes through some of the C's. But yeah, those just came through in alphabetical order, I believe. And yeah, so we give you date, stock symbol, exactly the option to buy, how much you should, or exactly the option to sell, how much you should sell it for, what that net debit would be, downside protection, the assigned and annualized return rates, how far in the money that option is, and then expiration date and keys there. And then you can also, of course, click on the ticker symbol there to pull up the option report for that if you want to see more information. The option report comes out in a PDF. We'll look at that in a second. But yeah, it's a nice PDF. It prints perfectly at 8.5 by 11, and it's got a lot more information on it. But yeah, this is a pretty powerful screener. There's hundreds of trades in here every day. So a lot of times there'll be something for you. And you can see in that furthest right column in the left-hand image, if that makes sense, we have the valid ranges there. So in terms of downside protection, we had a trade the day I made this slide with more than 35% downside protection. The highest annualized return rate was 78% and the lowest was 3.64. And so the valid ranges are all sort of included in there as well. All right, let's go to the next slide. Okay, so this bottom chunk here is essentially the same thing as above, but for ETFs. So again, hedge strategies, out of the money strategies, best 10 list, and then we have a sort search for that as well. It's basically the same control that just comes in and lets you sort and search through the ETF option reports the same way we just looked at with the stock ones. Okay, let's talk about the option report. Okay, so this is what the CFRA option report looks like. It's designed to be sort of a companion to the equity report if you're interested in doing option trades. And again, we cover everything that has a 3, 4, or 5 stars on the equity side, covered calls for as many names as possible, diagonal spreads for those where the math works. We cover the entire ETF universe, and all of these, because option prices change so much, they're all updated daily. And so, yeah, if you look every morning, it'll be based on the previous day's closing price. All right, and let's talk about what's in that report a little bit on the next slide. All right, so the top piece of the option report, it'll give you the company name and ticker symbol, show you the risk ratings for the covered call and the diagonal spread, as well as the CFRA stars rating. And then we'll give you the current price, where the price target is, dividend yield if available, some moving averages, and then option strategy summary is a pretty good description of what our option strategies are on that particular name. Discusses the upside, discusses the downside, and sort of compares the two strategies where both strategies are available. And then on the next slide, we'll get into some of these tables here. All right, yeah, so we got essentially a couple of tables and some charts coming down. The first one here compares basically the two strategies. Covered call, you buy the stock and sell an option. The diagonal spread, you buy an option and sell an option. So you can see the difference there. One costs $144.20 per share, one costs $65.80. And then the numbers sort of change as you go through like that. And then this comparison ladder shows you essentially, based on a potential stock price at expiration, what would be the best trade. So if you think the stock is going to be, in this case, above 66.87 at the expiration of that sold call in December, you're better off just holding the stock because it will have appreciated more than we're going to make on either of these trades. And then between 163.14 and 147.14, better off doing the diagonal spread. 147, right, I don't need to read this to you. You can see that how it works, but it goes on down and then it shows you where exactly the sort of the break-evens and everything are. And then the last two, I didn't break them out. Or hang on, let's do one more slide. Yeah, okay. So the next piece of this is the risk assessment. So we describe essentially what's going on with the covered call and what the risks to that strategy are, and what's going on with the diagonal spread and what the risks to that strategy are as well. So you get some idea of break evens and things like that. And then the bottom pieces of this chart here are two charts that show essentially a P&L for the different strategies based on a couple of different scenarios. One is in percentage terms and one is in dollars. And then there's another restatement of some parts of the trade at the bottom. And then there's another couple of pages that have like definitions and some disclaimers and things like that that I didn't include in the slides here. But that is that's the option product. And that's how it works. So I will turn things back to Charles for now.
Thanks, Bobby. That was a really great overview of the options product from Investors Observer on MarketScope Advisor today. Some really great stuff there, along with the options report that's available and a lot of really key underlying data underneath. We do have a couple of questions, actually, that we'd like to get to, if you don't mind.
Sure.
The first question is, which option reports or information are updated during the trading day?
Yeah, so that is the intraday. There's intraday trades. The first couple of things we looked at when we got to the MarketScope Advisor, those first two links. Yes, there's 3 of those that have trade ideas each day, and then there's a market brief that comes out before the market opens, and another one that comes out usually at mid-morning, and then also the morning update comes out before the open. So those things are all, we'll call that intraday. And then the option reports, so everything in the screener, anything that has that PDF report, those are all updated overnight. So
Great.
once per
Thanks,
day.
Bobby. Okay, terrific. Next question. Do you provide information for just buying and selling puts and calls?
Not currently. Not currently. We just have the covered calls and the diagonal spreads right now.
Okay, great. Thanks, Bobby. Next question. Do you display implied and historical volatility over under price data?
We don't, because the reports are only updated once a day, that those sort of comparisons aren't as useful as they would be if we were doing a super sort of fast twitch sort of strategy. And so we're doing month-long things that are updated once a day. So it's those sort of comparisons about how the options are priced are a little bit less relevant, we think.
Okay, great. Thanks, Bobby. Just some more questions. Don't I lose money on covered calls if the stock goes up by a lot?
No, that's one we get a lot, actually. And yeah, essentially, if the stock goes up by a lot, you may make less money than you would have otherwise. But that's certainly not the same as losing money. I mean, that's the logic that suggests you should put all your money in whatever the stock is going up the most, which I don't think anybody thinks is a good idea. So this is a way to be a little bit more conservative, but lose less often is the gist of the strategy here.
Okay, great. Thank you. Another question. Bid-ask spreads on options are typically very wide. What kind of price improvement should I look for?
Yeah, that's another good question. We don't really worry about price improvement a lot. In some cases, we'll try to move up from the bid a little bit if we're selling something, or down from the ask a little bit if we're buying something. But what we do here at Investors Observer is really try to focus on the dollars and cents. And so we structure the trade where the dollars and cents work the best in your favor, essentially by selling at the bid and buying at the ask, and don't really worry about trying to squeeze an extra nickel out of the market maker too often. So we don't really worry about it very much, and our algorithm works in such a way that it looks at all those things, and if the spread is really wide, it might move the price a little bit, but it's not. Yeah, we manage to find profitable trades that don't require a lot of price improvement, and so people get filled on the sort of things we publish a lot.
Okay, great. Thanks, Bobby. Looks like a final question that we have is, will my options be assigned if they become in the money?
Yeah, that's another good question that we get fairly often, and in most cases the answer is no. And there are technical reasons for that. The gist of it is, options have time value. So right, option prices go down as the option gets closer to expiration. And so typically if your option is in the money, there's still some time value there. And so it makes more sense to sell it than to exercise it. And so that's typically what happens. The one exception to that is sometimes you'll see options, calls in particular, be assigned ahead of an ex-dividend date. And even then that only happens if the time value left in the option is greater than the cash value of the dividend. So early assignment is relatively rare and pretty easy to predict. So it's not a thing we worry about here a whole lot.
Okay, great. In the time you've been discussing that, we actually have had 2 more questions come in, so we'd like to get to those if we can.
Yeah, sure.
If the underlying security breaks through your strike price, do you offer insight into diagonally rolling your strike up, or do you just settle for being assigned on your call?
We don't do either. Yeah, we typically just settle for being assigned on the call in the CFRA product. Currently in our products for individual investors, we try to do a little bit of that, but most of the time we just take what we can. One of the nice things about options is the trades close on a pretty regular basis, and so you can turn things over and look for the next best thing and don't have to worry about, is this going to keep going up? So typically we're happy to just close things when we planned and then look for the best trade once it closes in terms of where to reinvest that money.
All right, great. Another question we have is, in general, do you recommend market orders or limits?
Yeah, the one concession to the wide bid-ask spreads with options that we typically make is to use to use limit orders. So I put everything in for a net debit or a net credit go on the other side. And yeah, that is a concession to the wide bid-ask spreads to refer back to that earlier question. But that's really the only concession we make. Like, I don't worry about a lot of price improvement, but there is a price that I don't really want to do worse than, and so we do use limit orders for that. And that is, on the option report there and in everything we publish, we give you a net debit in terms of what to pay, and that is what you would set as your limit.
Okay, and final question. Do your trade return recommendations use the bid-ask quotes or prices in the middle?
In most cases, we use the bid. We'll move up a little bit here or there if the spread is particularly wide. But usually it's something approximating the bid on the sell side and the ask on the buy side. And that's just because a trading product where people can't get filled isn't really very useful to anybody. And so rather than picking a price and hoping it fills, we want to put a price out there that we know people can actually get into the trade on.
All right, great. Thank you, Bobby. So on behalf of the team at CFRA, we would like to thank you for joining us today. Within the next day, you will receive a note from us with a link to the replay and slides from today's session. Should you have any questions, please don't hesitate to contact us at cservices@cfraresearch.com. In the meantime, please check out CFRA's MarketScope Advisor for our latest research, as well as more information about the options research and features you saw today. If you're not currently a subscriber, please contact us at cservices@cfraresearch.com or visit our website, cfraresearch.com, to learn more about it and to receive a complimentary 2-week trial. Finally, we would like to invite you to our next webinar, Find and Analyze New Investments with Portfolio Tools, which CFRA will host in conjunction with Advisory World on Thursday, November 8th, 2018, at 11 a.m. Eastern. A link to the registration page will be sent to you later today. We hope you will join us for this session as we demonstrate how to use our hypothetical illustration and analysis tools to create hypothetical portfolios tailored to clients' needs. Once again, thank you for joining us today.